Goldman Sachs, JP Morgan, basically every major investment bank, and central banks around the world are trying to get their hands on as much gold as possible. So either the entire financial establishment has lost its mind, or they know something most retail investors still haven't priced in. And today, I'm going to break down the three forces driving this gold supercycle, clearly, simply, and without hype, plus what you can actually do about it. And quick fun thing, if you can guess where I'm filming from, you win a golden cookie. Now, I'm not here to sell you gold. I'm not a broker. I'm not running a fund. This is not financial advice. This is about one thing, following institutional money and understanding why it's moving, because that tells you where the long-term pressure is coming from. All right, let's rewind for a second, because this move in gold isn't normal. In 2025, gold didn't just go up. It went up hard. Roughly 55% in a single year. It printed all-time highs over and over, dozens of them. It was one of the strongest annual performances for gold in decades. And here's what makes that even more unusual. Gold is supposed to do well when everything else is falling apart. It's the classic fear trade. But last year, stocks also had a strong year, and gold still outperformed. That combination, strong equities and a strong gold surge, doesn't happen often. It suggests something important. This wasn't a panic bid. This was a structural bid. And the big institutions noticed it. Some of the largest banks raised their gold forecasts for 2026, not by a little, by a lot. And here's the key detail most people miss. When a big Wall Street bank says forecast and then adds with significant upside risk, that's not a casual phrase. That's Wall Street code for we think it can go higher and we don't want to look stupid if it does. Now, does that mean you should go out and buy gold because a bank said a number? No. Forecasts are not guarantees. Banks can be wrong. Everyone can be wrong. The better question is, why are they shifting their posture at all? Why is gold suddenly treated like the main event again? That answer comes down to three forces. But before we hit those three forces, I want to take a short detour, because the metal story isn't just gold. Silver is the warning light, and what's happening in silver tells you something critical about the physical market. Here's the detour. Look at silver inventories on the major U.S. futures exchange, where gold and silver contracts trade. Silver stockpiles there have been trending down for years. They're dramatically lower than they were around 2020, down something like 70% plus in broad terms, depending on how you measure total versus deliverable. And you might hear a number like 80 million ounces and think, that's massive. But here's what makes that number feel a lot smaller. We've seen periods where tens of millions of ounces were demanded for delivery within days, meaning a large chunk of available inventory can be spoken for very quickly if enough participants decide they want the real metal, not paper settlement. And that connects to something bigger. Silver has been in an ongoing supply deficit. Industrial demand has grown. Solar, electronics, data centers, advanced manufacturing, and everything that needs high conductivity. At the same time, mining supply hasn't surged the way people assume it will. And a lot of industrial users that used to keep bigger buffers, months of inventory, have reduced that buffer down toward weeks in some cases because carrying inventory costs money. So when demand spikes, the physical market tightens fast. And that's the point. The paper market can say one thing, but the physical market can say something completely different. And in the end, physics wins. If enough large players decide that paper promises are less attractive than real bars in real vaults, then the physical market eventually forces the price discovery mechanism to adjust. That's exactly the mindset central banks have. Central banks aren't buying paper gold, they're buying physical bars. And that leads directly into the three forces. So now let's get to it. Why is the world's financial establishment so obsessed with gold right now? Three forces. Force 1 is the foundation. Force 2 is the accelerant. Force 3 is the part almost nobody is positioned for yet. Force 1. Currency debasement, the quiet tax nobody votes on. Currency debasement sounds academic, but it's simple. Here's the clean version. Imagine you have a pizza with 8 slices. You and 7 friends each get 1 slice. Now imagine the government says, "We need more pizza," but instead of making a new pizza, they cut the same pizza into 16 slices. Everyone still has a slice, but each slice is smaller. That is currency debasement. No one comes to your house and takes your money. They simply create more units of currency, and each unit buys less over time. Now, the numbers matter here. During the crisis years around 2020, U.S. money supply measures surged massively. Trillions were created rapidly, and globally, the same pattern appeared across multiple major economies. Then what happened? Gold rose. Because gold isn't someone else's promise. It's not dependent on a government's discipline. It's scarce by nature. So when the amount of currency expands faster than the supply of real scarce assets, the scarce assets reprice. This is the part people misunderstand. Gold doesn't need to go up. The currency needs to go down. Gold is just keeping score. Now zoom in on the elephant in the room. Government debt. When debt gets big enough, governments don't have many politically acceptable options. They can default, rare and catastrophic for credibility, cut spending drastically, politically painful, raise taxes aggressively, capital and people adapt, and revenue often disappoints. Inflate the debt away, quietly, over time. Most governments choose the quiet option, not because they're evil villains, because it's the path of least resistance. Inflation makes money worth less, but it also makes debt worth less in real terms. That's why inflation is so attractive to heavily indebted systems. And here's what makes the current era feel different. Interest costs have surged as rates rose. Debt service has become a major budget line item. When interest becomes huge, the pressure to manage the problem becomes intense. And managing it often means lower real rates over time, more liquidity, more debasement. So if you want to understand the long-term gold bid, don't stare at daily headlines. Stare at the debt math. Now, people ask, is gold expensive at $5,000? That's the wrong question. The better question is, expensive relative to what? Relative to money supply growth? Relative to debt growth? Relative to historical periods where confidence was breaking? When you compare gold to broad money over long cycles, gold can still look under-owned and underpriced relative to the scale of currency expansion we've seen. Now, does that guarantee $10,000 gold? No, nothing is guaranteed. But it explains why institutions treat gold as a strategic asset again. Because debasement isn't a theory, it's a policy reality. And it's not just the US, it's global. Which brings us to Force 2. Force 2. Central banks are hoarding gold because trust got weaponized. This one is a game changer. In early 2022, something happened that quietly changed how central banks think. Western nations froze a large amount of a major country's foreign currency reserves. Whatever your politics are, pause and look at the signal that sent to the rest of the world. If reserves can be frozen, then reserves are not purely safe. They're political. They're conditional. And that introduced a trust problem into the global reserve system. Because for decades, reserves were treated as neutral savings. But after that moment, many countries, especially emerging markets, had to ask, if it happened to them, could it happen to us? And suddenly, the idea of holding huge reserves in someone else's liability became less appealing. So what did central banks do? They bought gold. Not a little, a lot. We've seen multiple years where central bank gold buying has been historically elevated, hundreds upon hundreds of tons, often pushing into the 1,000-ton range in many estimates. And this buying isn't speculative. Central banks don't buy gold because they think they'll flip it for a profit next month. They buy it because gold is outside the control of another country's central bank. Gold has no issuer. Gold can't be printed. Gold can't be frozen in the same way a bank account can. It's the ultimate non-aligned reserve asset. Now here's the part that's even more important. This looks structural, not temporary. Surveys and statements from reserve managers increasingly treat gold as a permanent part of reserve diversification. Meaning, even if geopolitics calms down, the behavior may not fully reverse, because once trust is broken, you don't get it back with a press release. You rebuild trust over decades. So central bank buying becomes a steady bid under the market. And if central banks keep absorbing large amounts of physical supply every year, that creates a pressure that doesn't care about daily sentiment. It doesn't care about RSI. It doesn't care about overbought. It just keeps buying. Now add one more point here. Some countries have relatively low gold allocations compared to Western nations, so they have room, if they choose, to increase gold as a percentage of reserves. And that creates a long runway for demand. That's force 2. Currency trust got political. Gold became the neutral option. Now, force 3 is the one most retail investors still aren't positioned for, and it's the most explosive one. Force 3. The gap. The crowd still isn't here. Here's the weird truth. Even with gold near record highs, most portfolios are not meaningfully allocated to gold. You'd think everyone would be piling in. They aren't. Yes, we've seen inflows into gold ETFs and more mainstream commentary shifting toward maybe gold deserves a place. But when you look at broad asset allocation behavior, global portfolio exposure to gold is still often tiny. In many cases, it's under 1% on average. That means something important. A massive gold rally has already happened, without broad retail participation. So what happens if that changes? This is where the gap becomes the supercycle fuel. Because gold is not a market where you can easily absorb a gigantic wave of new demand without repricing. Gold supply grows slowly. Mining takes time. Physical stock exists, but it's already owned. So price is the mechanism that balances demand. If even a small percentage of global portfolios decide they want more gold, say they move from almost nothing to a few percent, the marginal demand can be enormous. And it doesn't take everyone. It takes a minority. A small reallocation from massive pools of capital is still massive. That's why banks modeling modest portfolio shifts can arrive at high price implications, because the market isn't built to absorb big reallocations smoothly. Now think about what could cause the crowd to arrive. A stock market drawdown that scares people into insurance assets, a bond market event that breaks confidence in the classic 60-40 portfolio, a currency shock, geopolitical escalation, or simply the slow realization that cash yields don't keep up with real living costs. When the crowd arrives, it's usually late. That's how it works. People don't buy insurance when it's cheap. They buy it after the accident. But the crowd isn't fully here yet. That's the gap. And that gap is why institutions are positioning early, because they understand the mechanics of allocation shifts. Now let's connect all three forces together. Putting it together. Why this is a supercycle, not just a trade force one. Currency debasement. That's the long-term tailwind. Force 2. Central banks. That's the structural bid that doesn't care about headlines. Force 3. The gap. That's the potential surge of additional demand that hasn't arrived yet. And around all of that, you have a separate but related pressure in silver, physical tightness, industrial demand, and shrinking visible inventories. Silver's paper price can be pushed around in the short term, but if the physical market stays tight long enough, the stress shows up somewhere. Premiums, spreads, delivery delays, inventory drawdowns. And when physical becomes the constraint, paper narratives lose power. That's not a guarantee of a dramatic break, but it is a warning that the physical side matters more than most people think. Now, none of this means you should go all in on gold. That's not smart. Supercycles can be volatile. They can have brutal pullbacks. They can shake people out. The goal isn't to bet the farm. The goal is to position sensibly. So let's talk about what a sensible approach looks like, without hype, without fear, and without pretending anyone can time the top. What smart investors actually do, instead of chasing headlines. First, they separate two goals: protection, opportunity. Gold is primarily a protection asset, a hedge against monetary disorder, against policy mistakes, against currency dilution. Silver can be protection too, but it's more volatile and more tied to industrial cycles, and it can be more easily shaken out in paper markets. Second, they avoid leverage. In metals, leverage is how people get wiped out. They get the thesis right, and they still lose because they can't survive the volatility. Third, they think in allocations, not all or nothing. Most serious investors don't say, "I'm a gold person." They say, "I want a portfolio that survives multiple outcomes." That can mean quality equities, productive assets, some real asset exposure, and a measured amount of monetary metals as insurance. Fourth, they focus on what actually drives price: money supply trends, real rates, rates minus inflation expectations, central bank purchases, ETF flows, and physical market signals like inventories and delivery tightness. Those are the levers, not daily headlines. Now, a quick word on miners, because people always ask. Gold miners and silver miners can outperform the metals because they have operating leverage. If gold rises and costs don't rise as fast, margins expand. But miners also carry extra risks: management, execution, geopolitical and permitting risk, cost inflation, operational failures, financing, and dilution for developers. So if you're touching miners, treat them like what they are: higher volatility, higher upside, higher downside. Position size accordingly. Don't confuse a miner with a gold bar. They're not the same thing. Now let's end with the most practical part. What should you watch going forward? What to watch from here. If you want to follow the supercycle without getting emotionally whipped around, watch a short checklist. Central bank purchase trends. If central banks keep buying at elevated rates, the structural bid remains. Money supply and deficit trends. If money and debt keep expanding, the long-term debasement tailwind remains. Real rates. When real rates fall, gold tends to benefit. When real rates rise sharply, gold can struggle short-term. Physical market stress signals. In silver especially, inventory drawdowns, delivery tightness, premiums, spreads. Retail allocation behavior. The moment the average investor starts talking about gold at dinner parties, you're in a different phase of the cycle. We are not fully in that phase yet, and that's exactly the point. Closing. The reason institutions are scrambling for gold isn't because gold is new. It's because the world is changing around it. Money is being diluted. Debt math is tightening the policy box. Reserve trust got weaponized. Central banks are hedging, and the crowd is still underallocated. That combination is how supercycles are born. Not from fear, from structure. If this helped you understand what's actually driving the move, share it with one person who still thinks gold is just a doomsday asset. Because the real story isn't doom. The real story is that the biggest players on Earth are positioning for a different monetary world, and you don't need to copy them perfectly. You just need to stop ignoring what they're telling you with their actions. Hello, what I do in room.